Welcome to the Financial Armor Show. My name is Brad Cooper, president of Cooper Financial Investments. And as always, I want to welcome my amazing co-host, Tony Shore. How you doing today, Tony?
I am so good, Brad. I have had a great week, and
Yes.
now I'm here with you. What could be better?
Nothing can be better, Tony.
Nothing.
You know,
Absolutely nothing. Enjoying the nice summer heat out there.
yes. I'm sure you are, from Minnesota, but here in Arizona, it's kind of warming up. I think I saw the forecast this morning for the next 10 days, and I think about a week from now, it's going to hit 115 degrees.
Oh, no.
That
Yeah.
is crazy hot. But
Yeah,
you know what, Tony?
that's too
For
hot.
all the people that don't live in Arizona, it's not really that hot. It's a dry heat.
Right.
You
Right.
know, the
So
the
instead of a sauna, it's an oven.
it's an oven, and that's the best exclamation you can have. Go into your kitchen tonight, crank your oven up to about 500 degrees. 30 minutes later, come back, open the door, put your head in it,
No.
and you'll get to experience 115 degrees in Arizona.
Woo! Yeah, that's what it feels like. That's nobody wants that. Hey, then we
Yes.
praise God for air conditioning, right?
You're right. Very thankful, and
For fans and air conditioning. That's all I can say.
but I come from the Midwest. I know you're born and raised in Minnesota,
Yeah.
and one thing I do accept better than the other is I would rather have 110-degree temperatures for a few months than snow and ice and negative temperatures, and then during the
Negative
summer.
20 degrees below zero with a 50 below wind chill, so
You're
you can't
right.
go outside for more than 5 minutes or you're gonna get
Are you
freezer burn on your
or you're
skin.
dead. Or
Yeah,
then in the
yeah.
summers, I know back in Missouri, a lot of times it got up to 95 to 100 degrees, but the humidity was over 100%.
Oh, yeah, yeah.
So, but you know what? I think, the best case scenario is probably San Diego for most of us, but
Well, yeah. I mean, obviously, Southern California has the best temperature in the United States, really, if you want to look year round. But then you have other things. You have earthquakes and fires. So, there's always the good with the bad, no
and
matter
high
where you're
taxes
at. And well, what did you say? You didn't say
and
Texas, did you? We're not going to
high.
bring them into it, are
No,
we?
not at all.
No, but every state has a lot to
Yes,
offer, I think.
that's
And
true.
I love my home state of Minnesota, but I'll tell you what, I've always loved the time I've spent in Arizona with you. So that's awesome.
And
Now, what
same
are we
here.
talking about today on the show?
You know what, Tony? We're going to talk about 10 key retirement ages.
Yeah.
10 key retirement ages. I just came across an article that I found very interesting. I wanted to share with our listeners. Came from U.S. News and World Report. 10 important ages for retirement planning. And I thought we would just go through a lot of these ages and the importance when it comes to financial planning that you should know with these ages, which a lot of this you may know, some you may not.
Yeah.
And
There are a lot of milestones along the way that
you're
you're
right.
gonna talk about today that I think people need to know about, and they go, "Oh, I've heard all those, 65, 67, maybe 59 and a half." But there's a lot more to it, and there's some other ages. You may not
You're
you may
right.
be good for a refresher course, to make sure you're paying attention at each of these ages for the planning that needs to be done, right?
You're right because, there's so many different factors, Tony, when it comes into the ages we're going to talk about. And, for example, taxes, Social Security income and taxes, healthcare costs, and the
Yeah.
list goes on. So you definitely want to pay attention if you're listening, to some of these key ages that are very important. Let's start out with the first one. For those 49 and younger. So, Tony, you would fall in this category, right?
I
49 and
wish. Not
well,
for many a moon. Yeah.
mi unfortunately for you and I, Tony, we don't fall in this category, but if you're 49 years of age and younger, the 401k contribution limit is $24,500 a year in 2026. The IRA limit for contributing is $7,500, but start starting early and saving is just, one of the best things that anyone can do. I was just having this conversation with one of my advisors last week, Tony. 26 years old, one of the most sharpest 26-year-olds I ever met in my life. And what he has to save per month to achieve $1 million versus what you or I would have to save is a big difference.
Huge
Why?
difference, right?
Because he has about 40 years to
Right.
save in compound interest.
Yeah, can you imagine? I wish I had started much younger. They say hindsight's 20/20, but in this case, hindsight's about 20 million. If you'd started putting away, like my daughter, she's putting 200 a month, or trying to at
Right.
least,
Yes.
putting 200 or close to it a month into an IRA, and she started that when she was 21.
Yes.
So by the time she's 65, she should be set for retirement.
That's right, and that's what's fun, Tony. We're having the privilege and honor of really sitting down with a lot of our clients' children and even grandchildren,
Yeah.
and that's what we enjoy doing and educating them on the importance of just starting out and what little it takes. My daughter's doing the same thing, Tony. What little it takes, but then at age 50 or older, that's where we fall into this category,
Yep,
right?
yep.
There is a catch-up contribution. Workers 50 and older may contribute up to $32,500 per year in most 401ks and similar plans.
Wow.
IRA savers that are 50 and older with the catch-up provision and contribution can now put into an IRA, whether it's a traditional IRA or a Roth IRA, in the amount of $8,600 per year.
Wow. Wow, so that's really good. 32,500 if you're 50 or over, to your 401k or similar employer-sponsored plan, or if you have an IRA and you're 50
Right.
and older, you said 8,600. You can contribute up to 8,600. And some people might say, "Oh, I don't know if I can put that much money into a retirement plan each year." But you know what? It comes out before it sees your bank account, or
Right.
immediately when it hits your bank account. Some gets automatically transferred into that
True.
retirement account. If you never saw it, you'll never miss it. You'll be able to budget
Yes.
without it. I just think people have learned that hey, you can save more, and you can live on a little bit less and have a lot more later, right?
You're so true, Tony. Out of sight, out of mind, I call it.
Yeah.
And it always goes back to, why does the IRS automatically take money out of your paycheck to go to the federal government instead of sending you an invoice monthly for you to pay? It would
Right.
probably never get paid.
Right.
Treat treat a contribution, whether it's a 401k or an IRA, as a bill, a necessity. And it's been proven, through human behavior and habits, after you do that for a few months, it becomes a habit and you
Yeah.
don't miss it.
Well, you don't miss it because you don't have it. If you never had it, it's hard to miss it. And the trick I learned, Brad, and this really works for me
Right.
and my wife, but what I did is, that money, the retirement money, that's not my money. I don't view it
That's
as my
right.
money. It's just like tax money. I don't view it as my money. Uncle Sam's going to take that. That's not my
Right.
money. So I don't count on that. But the money I'm putting, like I contribute 15% into my 401k. I never thought I could get there. I thought I
Right.
was squeezing out 6%, right,
Yes.
to get a full match. But you know what? What I realized is that once you take the attitude, that's not this Tony's money. It's not mine. That's future Tony's money.
Future.
That's a different person, future Tony. He's
Right.
separate from me. Future Tony is not me. I'm current Tony. Current Tony gets what's in the checking account.
Right.
Future Tony gets what's put into the 401k and the IRA. And so if you have that mindset and can separate it out like that, I don't
Wow.
even realize I have that money. Some people think about, oh, I've got all this money over here. No, you don't. You can't touch that until retirement. That's not your money. That's retired Tony's money, or retired uh, Brad's money, right?
Very well put. And if you look at it that way, and two, the IRS helps out because if you pull money out before 59 and a half, you'll be hit with a 10% penalty in
Right.
most cases. So one thing I want to add to this, Tony, too, because we've talked about 401k contributions, IRA, just going back to 401k. Wow, if you're over 50, 32,500 a year, that's great. I would recommend a 401k Roth
Hmm.
instead of a traditional 401k. And
Yeah.
if you have any questions, if you're listening, reach out to us because I'm all for tax-free accumulations and tax-free distribution and income when I do retire. And then lastly, we talked about traditional IRA contributions or even a Roth IRA. There are income restrictions. If you make too much money, you want to be very careful and not contribute to a Roth because that could come back and backfire. That's an area that we talk a lot about at Cooper Financial in our meetings. I get a lot of questions on that. So there
So you
is
don't
ways.
Yeah, there are
No.
ways and strategies, but you don't want to do that without working with somebody like yourself and your staff there at Cooper Financial Group, because that's what you do. You look at these things at Cooper Financial Investments and Cooper Financial Group. You can say, okay, here's your limits on Roth based on where you're at. Contribute that much here to get money in a tax-free bucket. So you have
Right.
tax-free income in retirement. So you don't get bumped up into a higher tax bracket at any point in retirement. That's so important to have those strategies. And for people 50 and older, they need to make those catch-up contributions, but some might want to go into a Roth, like you say. So for our listeners that have questions, I hope they'll pick up
Right.
the phone and give you a call. It's just 888-390-5277. So let's move on to the next one. We talked about 49 and younger, focus on saving, focus on compounding interest, let that money grow. 50 and over, look at how much you can put in to get some catch-up contributions going. And what's the next stage you want to talk about?
The rule of 55, Tony. The rule of 55 allows penalty-free withdrawals from a current employer's 401k if you leave your job at 55 or older.
Without the penalty. So you can avoid that 10% penalty.
Penalty,
And we're
but
going to
not
talk about,
taxes.
but you cannot avoid taxes. If you do pull money out of a 401k at any age, you're going to pay taxes unless it's a Roth, right?
That is correct. And what my CPA always reminds me is, Brad, if you don't pay taxes from a traditional 401k or an IRA when you pull it out, Brad, I don't think you would look good in orange. And
Right. You
that's
got
what
to
would
do it.
happen if you don't pay taxes. But you know, so that's a rule that most people I find, Tony, are not familiar with. It's the rule of
Sure.
55, and then most of us are familiar with the next rule is at age 59 and a half, which
So what happens at 59 and a half? I know we've heard, and I wish it's classic government IRS rules because it's a half. They couldn't have just went with 59
exactly.
or 60. It's
Be too
59 and a
easy.
half, even though none of us past the age of 5 celebrate half birthdays. I always point that out because a 5-year-old might celebrate his half birthday or want to. But we're adults. I don't know why the government thinks we're going to keep track of our half birthday when we're 59 years old, but
But this is a birthday that you want to be aware of and mark on your calendar.
right, right.
59 in 6 months to be exact. And here's the
Yeah,
reason why. Whether it's a 401k plan, a Roth IRA, whether it's Roth or traditional, and including life insurance too. I'm going to throw that in here as well. When you're 59 and a half or older, you no longer, if you pull money out, will be subject to a 10% penalty. However, like we talked about earlier, you can't avoid taxes legally, and you will have to pay income taxes.
yep. Yeah,
So,
so that's really important. Unless it's in a Roth, then qualified. If it's a qualified Roth withdrawal, then those are tax free, which is nice. But
that's right.
most of your retirement accounts that most people have these days are traditional IRAs, 401ks, 403bs, TSPs, where that money is fully taxable because it was tax deferred when it went in.
Right. And let me share another important thing about 59 and a half, which I'm finding a lot of people aren't aware of, Tony, is let's say you're still working and you plan on working for a few more years. Now you're 59 and a half. Let's say you've done a great job with your 401k, regardless if it's traditional 401k or 401k Roth. let's say, I'll just throw out a number. You have $1 million in the account,
Right.
but now you're approaching retirement in the next maybe 3, 5, 7 years. What the IRS will allow you to do, and most employers as well, they will allow you to do what's called an in-service transfer or rollover into your personal IRA. So why would you want to do that? If you roll over while you're still working, most employers allow this, the majority of your 401k into an IRA, number one, there's no taxes if it's done properly. All right. So it's going from one taxable account to another taxable account. The reason why you want to do that is number one, you have more control over it.
Mhm.
Secondly, you can choose and in a lot of cases have a better selection of investment choices and other investment options, which you may want to take less risk. And that will allow you to do that. So a lot of times, as we're doing the financial planning process and gathering information, finding out the goals and objectives, a lot of times, not 100% of the time, but many times we're recommending that. But in some cases, it may not be in your best interest. So be aware of that when you're 59 and a half, you're still working, you can do that rollover and transfer in most cases with most employers.
Yeah. Yeah, I think that's really important to note. I'm glad you brought that up, and that's these are the types of things that people can miss, and that's why you need to work with a trusted financial services professional like yourself. So, 59 and a half, people
Right.
realize that you can't take out money from a tax-deferred retirement account before age 59 and a half without a 10% penalty on top of the
Right.
taxes you're going to have to pay. What's the next age you wanted to talk about, or age group?
Well, for some of us, and Tony, I don't know, have you hit the magic number of 60 yet? You're still 59, aren't you?
No, this year that I did in March. Yeah,
You
yeah.
did already. Well,
The
happy belated
the
birthday.
the
So
big
you're in the
60.
60 club. Okay.
Yeah, yeah, I am.
Well, here's some good
I don't
news
look,
for
or
you.
well, I don't act it yet,
No,
Brad.
and you
Yeah.
don't look it. That's why I thought you were still like 40.
Yeah,
So,
right.
but anyway, congratulations. Here's
Yeah.
where if you're age 60 to 63, all right, key numbers, key ages. Under the Secure Act 2.0 that went into effect January 1st of 2023, now you may qualify for what's called a super catch-up contribution. A
Wow.
super catch-up contribution. In 2026, the enhanced catch-up limit for most 401ks and similar plans is 11,250. So now, Tony, as a 60-year-old, you can, if you choose, contribute up to $35,750 into your 401k
Per year. Per
per
person.
year.
Per person, per year, if you're 60 to 63, anywhere in between, right?
That's
So
exactly
so,
right.
I can contribute up to 35,750 to my 401k. I'm gonna need a raise, I think. Brad, is there anything you can do for me? Put in a good word?
I can, Tony, and
Thanks.
then maybe you could have once I give you that raise, an extra couple $100 left over after every paycheck. It's interesting. I've been self-employed for 33 years now,
Yeah.
and what salary I pay myself, on a weekly basis, and then we get compensated being self-employed in other ways. But every time I get a paycheck, every other week, Tony, it's like a few $100 because I'm maximizing my 401k Roth
Yes.
contribution.
Right.
And
Yeah.
and let me just add this before we move on real quick is one thing that I'm very thankful and humble and proud of is what I've learned from many of our experts. And Tony, I'm speaking for you as well as, everything that we talk about on this show, we're actually doing. For an
Right.
example, 401k
Right.
Roth
Yes.
IRAs, IULs,
Yes.
tax planning, and the list goes on. So
Yeah,
that's what's
exactly.
keeps me motivated. Well, let's
Yeah.
talk about the next stage,
What's that?
62. So
62
Tony,
is one I've heard a lot.
2 years, less than 2 years from now, you'll be 62. So that's the earliest age unless you have lost a spouse. And then at age 60, you could take what's called survivor benefits from your deceased husband in many cases. But For the majority at age 62, you can claim Social Security.
That's the earliest you can claim is 62.
But, capital BUT,
Yeah,
but by doing so, you will take, a big reduction of your monthly benefit
sure.
by doing so.
So if you versus what? Versus waiting until when?
Full retirement age. For an example, today, myself, you as well, your full retirement age is probably what mine is, Tony. It's
It
based
is.
on your date of birth, is 67 years old.
Yeah, it is
So
67. The majority of our listeners out there, probably their full retirement age is
right,
67 if they haven't already hit their full retirement age. If you have, it might have been 66 or 66 in some months. But for
right.
most of those who haven't yet retired or hit those ages, it's going to be 67, right?
That's right. So at full retirement age, you get your full Social Security benefit. Then every year thereafter, the increase per year on top of your Social Security benefit from full retirement age is about 8% per year on
Sure.
average. So that would increase. So, Tony, since we're talking about Social Security just for a second, let me just address our listeners. This is not black and white. I
Right.
could share story after story where it makes sense for a 62-year-old to take Social Security. I
Sure.
can share with you many stories why 67 at full retirement age is, and then many stories on why 69 or 70
Yeah.
is. And how do we determine that? We have a team of Social Security experts, I call them, in my opinion,
Yeah.
that help
Specialists
us
that
prepare.
deal with this all, day in and day out for people, right?
And what we do for our clients is what we call a Social Security maximization report. And
Yeah.
that will tell you personally, based on your numbers, your work history, your earnings, when is the best time to maximize your Social Security benefit and file.
And it'll at least give you a starting point, knowing where that sweet spot is for you based
Exactly.
on a projected longevity. Now, if I could tell you the exact day I'm going to pass away, then you
Boy,
could tell me exactly when to file to maximize my benefits with no doubts. You're going to file at 63 in 2 months, or whatever it would be, and you'll be that will be the most you could get. But no one knows the exact day or time, so there is some leeway plus personal circumstances. What are your retirement goals? How much money are you going to need?
exactly.
When are you going to need it? Where are your other sources of income? Right. We've done whole shows on this. But you're right. When to file is a big decision. I wouldn't make that decision without
No,
meeting with you and the staff and having that report run. My wife and I have both have had that
great.
report run. Yeah.
And I hear story after story, month in, month out, Tony, of the nightmares of getting bad advice, no advice, or even worse, their neighbor, Bob. Hey, Bob says file at 62 because it's not going to be around anymore and you need to take it. Big
Yeah.
mistake.
Yeah.
Everybody's situation is completely different, which leads to another big age point is 65.
Oh,
So what
yes.
65, there's a 7-month enrollment window. And if you don't file in this 7 month, there's a penalty, but also filing for Medicare, Part B. And once you file for Medicare, and once you start receiving Medicare, $202.90 per month based on your income bracket. If you make more than, I think it's 218,000 joint, you're going to be paying what's called a surplus, which is IRMA,
Sure.
which we've talked about. But 65, when you approach 65, just remember there's a 7-month window which you at least need to file for Medicare.
Yeah. There you go. Well, Medicare is a big one, and that's why a lot of people assume. I think I hear from a lot of people, "Oh, my retirement date, or I'm going to file for Social Security or retire when I'm 62." Well, why? Because that's when I can file for Social Security.
Right.
Or they say 65, and I say, "Why is that your date?" Because that's when I can get Medicare. And I go, those are two good reasons. You want to
Yeah.
know when you can take Social Security and when you'll have Medicare because you need medical insurance is really expensive.
Right.
But those aren't necessarily your retirement dates, but you should look at them and they're important. And Medicare eligibility, you want to make sure, you don't want to. There's an enrollment window And if you miss that, it's a penalty, like you say. So you want to make sure you get that taken care of. Now, you have in your office a Medicare specialist, right?
We do, and so important, Tony, that you bring this up. You want expert specialist advice from a Medicare person because
Hmm.
that can make or break you in the healthcare arenas. It's all, again, that's based on everyone's situation's different. Your health,
Sure.
your medicines you're taking, the doctors you see, and the list goes on. So definitely consult a specialist that knows Medicare inside and out. And in my opinion, we have one of the best.
Yeah, that's great. I know you do. That's fantastic. Now, what's the next stage you want to talk
Well,
about?
two more ages. One, just this is pretty simple. At age 70, just a reminder, is the latest age you can delay, and you will have to start Social Security. So,
Yeah.
age 70, if you haven't taken the money, which is funny, Tony, I haven't come across anyone that said, "Oh my gosh, I'm 70, Brad. I forgot all about Social Security."
No. No, if somebody's 70 and they haven't yet filed for Social Security, they've been thinking about it probably every day since they turned
Exactly.
62 or 65. Yeah. Yeah. So, even if it made sense for them to wait, you think about it and you're worried about it. So, again, don't decide when to file without getting that report run. I know you're more than willing to sit down and talk with folks. There's no charge or obligation to sit down and ask questions about that. Now, what's okay? That's 70. We've talked a bit about Social Security. What's the final age you wanted to talk about?
The
What's left?
final and number 10 age is today, the magic number 73.
73. What happens at 73?
Now come 2033, it's gonna be 75, but today it's 73. That's when the IRS will force you to take what's called an RMD. What's an RMD? Required minimum distribution. Whether you want it or not, Tony, you will be required. Now, you do have a choice. If you don't take it, I think the penalty is like 25%,
It is
50%
now
if you don't take it. It used to
25%.
be 50, right?
Yeah, it used to be 50%. And that I want to note, if you don't take your required minimum distributions out of those tax deferred accounts, it's a 25% penalty. And Brad, let me ask, that's on top of taxes that
You're
you owe,
exactly
right?
right, Tony. On top of taxes. So if you're in the
Oof.
20% tax bracket, you're looking at about only 55%.
55% of the money will go to Uncle Sam.
And that's
So,
based on today.
so you don't want to miss an RMD. And I know
No.
you set that up automatically for your clients. And so they never miss an RMD, right?
But what we're doing with the majority of our clients, Tony, we're being proactive. And we've had Ed Slott, one of the top
Yes.
tax experts in the United States, on our show a couple different times. We, with the help of our CPA team and Ed Slott's office, we do a lot of tax planning with the help of them. And our goal with the majority of our clients is to convert the majority of their IRA money to tax-free accounts, Roth
Sure.
IRAs and other accounts, to avoid being surprised at taking a large RMD that could push you up in a much, much higher tax bracket
Yeah.
in the years to come. And if taxes increase, which most of our experts say they will,
Yeah.
you don't want to be giving 50, 60% to the IRS. And so that's another area which we're doing a lot of and getting a lot of questions. And probably the main topic, Tony, that we're discussing in meetings today is, Brad, help us put together a plan to go from taxable accounts to tax free.
Yeah, and taxes are a big part of income planning, even investment planning, and
Social
when
Security, Medicare, the list
yeah,
goes on.
right, it goes on, but, people might wonder, "Well, I'm 57 or I'm 60 and just thinking about now retiring. I don't need to worry about age 73 yet." Actually, you do, because if you wanna minimize how much your
Yes.
RMDs are at that age, you wanna work with a financial professional now and maybe spread out some of those withdrawals to, spread out the tax burden, or come up with a plan on when you're gonna start taking money out of those accounts or when you have to and what to do with it, right?
Absolutely, Tony. And, just personally, I'll be 59 in October. So I'm way younger than you,
Wow.
Tony.
Yeah, you are. Well, you look a lot young.
Hey,
You look
I'm,
49.
I'm catching up to you real quick. But just, I share that with all of our listeners because I just recently, in the last 30 days, converted my last IRA. When you convert, an
Oh, to a Roth.
IRA to
Yeah.
a Roth,
Yeah.
even if you're not 59 and a half yet, the IRS will waive the 10% penalty.
Wow. That's
Now, do you
awesome.
have to pay taxes? Yes. So
Sure.
that's a
Well,
big part of our
sure.
planning.
If you're taking any money out of a traditional IRA, unless it's going into another traditional account, which I don't know why you'd transfer from a
Right.
traditional IRA into anything else that's traditional or tax deferred. But if you transfer it into a Roth, which is tax free, you do have to pay taxes on that money at that time. And that may be why you want to spread it out and do Roth conversions here and
That's
there.
right.
And you've already been
Exactly.
doing that. Yeah, see,
So
there you
that's the
go.
fun part of we do. So, well, I could probably go on another hour, Tony, but
Yeah,
I
well, I
know
think we've covered a lot of ages and a
we
lot of
have.
facts, and hopefully some information that our listeners and viewers can use today. I think it was a lot. If they have questions, Brad,
Yes.
how can they get a hold of you?
Yes, feel free to visit us online at financialarmorshow.com. Again, that's financialarmorshow.com, or you can call us toll free 888-390-5277. Again, that's 888-390-5277. And we just love the questions we get from our listeners. And our goal and passion here at Cooper Financial is just to further educate, consumers, Americans, and because I realize every day we just don't know what we don't know. And that's where we can do our part on the financial side to help.
Excellent. And once again, they can get answers or hear past shows at financialarmorshow.com. And that number, one more time to call to set up a no-charge consultation, 888-390-5277. That's 888-390-5277. Brad, thank you for a great topic and all the great information today. Listeners and viewers, thank you for tuning in. That does it for today's episode of the Financial Armor Show with our host, Brad Cooper.
Thank you, Tony.